welcome back to another episode of With Sonar. And if you were tuned in just a moment ago, you saw a great commercial for F3, stands for Future Freight Festival. It's going to be a good time. Tony, you looking forward to it?
It's going to be arguably the best conference in freight. I mean, if you're not excited for it now, you better be, because it's coming quick, and obviously there's not a lot of accommodations in the Chattanooga area, so you better get on it. And I mean, you start looking at some of the names that are performing, some of the demo companies, some of the experiences that are going to be there. I mean, it's going to be tough to beat. I know last year was pretty fun. I think this year I'm going to one-up it.
I know none of you feel enthusiastic after how Tony just described that, but he's absolutely correct. First off, there's 13,000 hotel rooms / Airbnbs in Chattanooga. So if you're one of those, you're going to have to nap one. But anyways, absolutely correct. It's going to be a good time, obviously, because I'm going to be there. But more importantly, because Tony will be there. That's right. You get to hear all the good things from Tony. But it's going to be fantastic. There's going to be thousands of people there. Live performances of music. It's just different, all right? Yeah. Like, these types of conferences just hit different, all right? If you've ever been to a conference in the supply chain space before, they stink. And that's not unique to supply chain conferences. That's really just business conferences in general.
Yeah.
And I should say most of them. There are exceptions. The Dreamforce conference tends to have a very robust reputation, right? They have music, they have all that stuff. So I'd say there are others out there that do it really, really well. Mm-hmm. Phenomenal. But I'd say, in our industry, there isn't somebody that really goes above and beyond, and that's something that we're trying to do. So it's just fun. It's a good time. And let's be honest, why are you there? You're there to network. Yep. At the end of the day, you're there to network and maybe learn something that can help you do your role better. And this is a great place to do it, because the venue, everything stops around 3 or 4 o'clock in the afternoon, the conferencey stuff. And then it's hey, let's go enjoy the after parties, right? Let's go enjoy, and it's not just a networking time, we're sitting at a cocktail hour. It's you're networking at a live band.
Yeah, exactly. And it goes, when you really break it down, when you start factoring in that, hey, conferencing stuff ends at 3 o'clock, but there's stuff planned till 11 o'clock.
That's right.
That is a lot of time to network and meet people in the industry that are, a lot of time to share the knowledge across the industry, because that's the only way to advance, right? If you silo off knowledge, nothing changes. And that's the whole point.
We have this show right here. The knowledge that gets dropped in this show is unrivaled.
That's one way to put it.
Why are you laughing, Tony?
That's one way to put it.
There's nothing to laugh about. It's true. Right? What more could you learn? Used truck prices. You want to know, you got to come right here. Speaking of used truck prices, what a segue. We're talking about used truck prices today. We're talking about used truck prices. We're talking about some mergers and acquisitions. We are talking about market share. We're talking about freight rates. We got a lot to talk about. But first off, used truck prices. They're falling.
Yeah, there's no way to deny what. It was coming.
Let's put the chart up on the screen as soon as you can. For folks to be able to say.
It's going to be. It's ugly, and it should be ugly.
Now let's say as soon as the chart gets up the screen, right there it is. Okay, so yellow line is used 3-year-old used truck prices down to around $70,000 approximately, right?
Yeah.
71,000.
Yeah, it cut almost in half in a year.
Tony, who is this bad for? Who is this good for?
Well, all right. It's a combination of a few things, right? It's good for those that want to enter the market, but you're entering the market at a bad time. If you're rolling off equipment, it's not a good thing, because your gains on sale will be less, because the vehicle is worth less.
Right.
Right? So I think it's interesting during the pandemic. You look at that, or not even the pandemic. This is all the way into last year, right?
This is 14 months here.
Right before the bottom gets pulled out from the freight market, there was incentive almost for carriers, especially larger fleets, while they wanted to grow their fleet, there was also incentive for them to turn older equipment over, because the prices were so high. You're talking almost $150,000 for a used 3-year-old truck.
Which is what? The price of a brand new truck today?
Yeah.
If that, maybe less.
The issue was they couldn't backfill, right? Anything they rolled over, they couldn't get the orders or the equipment built fast enough to backfill it. So it's they couldn't necessarily really take advantage unless they reduce the size of their fleet, which you didn't really see.
Right.
But they didn't really grow their fleet either. Who this really hurts right now is the owner-operators that bought the equipment at those peak prices because they were trying to get in the market. And you look, when the fall really started was right as the freight market shifted, right? As the market shifted, give it 2 months and then the prices follow, right? Used truck prices. And ultimately, it's a supply and demand issue.
I'm just saying, it kind of looks like tender rejections there in blue signaled this drop about a year before it happened.
Yeah, it's not, I mean, yes.
I mean, it's easy to see that in hindsight, but I'd say like in all reality, you probably would have waited 6 months of declining tender rejections before you made the decision, right? Like I'm looking here, like tender rejections, it looks like peaked out in Q1 of 2021. You wouldn't have known at that point that was the peak.
Yeah, no.
Right? So you would have waited probably till the end of the year to realize, oh yeah, we're still continuing to accelerate downward.
Yeah, the market's still tight, but it's, at that point, rejection rates, just given where they were, I mean, you're talking upwards of 20% all the way, through January of 2022?
Right, so
the market was tight. All that is more of a function of rates and rate changes and the upward pressure on contract rates. And then some of that was capacity couldn't catch up, right? And it couldn't catch up. And as you started to see, this is where the used truck prices, this is ultimately a matter of supply and demand. Larger carriers didn't want to roll over their fleet. Why? Because look at rejection rates. Market was tight. They needed all the available equipment they had. And demand was strong. So supply's limited because the carriers that would normally be putting equipment into the market were not doing that. Demand's high because look at rejection rates. When rejection rates are that high, it's a positive for rates. People entering the market are chasing those high rates. Demand increases when carriers want to enter the market, and ultimately it creates this spiral of used truck prices, used equipment prices increasing. Now we've kind of seen the opposite, right? Market slows down. Carriers are now sitting on equipment that, hey, it's a little easier to get new equipment. We can roll this off, and the demand's not there. And I think that's why you're seeing it's both a supply and demand dynamics on why you saw it increase and decrease. And it doesn't react as fast as the actual freight market does, but it does follow it. You're talking a matter of a couple months.
3 to 6 months.
Yeah. So
right, depending on where you are, it's about 3 to 6 months. So, I'd say like tender rejections have probably been at their bottom for about 3 months. So I'd say used truck prices, assuming that was the bottom, will probably, they're either just now reaching their bottom or they'll reach their bottom in the next month or two.
Yeah, I mean, it seems that way, but I mean, you look at the pace at which it's declining, right? The slope of that line is almost accelerating in the past few months. And I think that's the concern.
That's what I'm saying. It's either there or another couple of months.
Yeah, I mean, you're looking probably by the back half of the end of the year leveling out, hopefully. But I mean, you're talking. We'll see what happens. I got the
numbers right here. I got the numbers right here.
But overall, I mean, right now, if you're in the market for used equipment, like give it a few months because you may
get a better deal. I mean, let's say like the market bottomed right before COVID at $52,000. So it's like, are we going to go down to that? I mean, maybe we do, but it's like.
It's hard to say because
we're basically at 2019 highs right now.
Yeah.
We're at 2019 highs. We're actually slightly below 2015 highs.
That's interesting.
Believe it or not. So like this is like we're at 2019 highs and we're below 2014 to 2015 highs. We're actually below those. I don't know why, but we are.
Yeah, it's interesting because I mean ultimately it doesn't matter because look at where rejection rates are at 4%.
They're still basically on the floor.
They're so low that you have to churn capacity. When you churn capacity, people end up selling equipment. It floods that market. So until there's something that a demand side indicator that will firm up, the demand for used trucks, I don't think there's a whole lot that says, hey, these are really going to firm up anytime soon.
I'm glad you brought up tender rejections because they've been on the rise. In fact, they recently just hit above 4%, almost the first time this year, minus the initial week of January. But they've been on the rise. Let's go ahead and pull that chart up if we can. So we're going to compare tender rejections to rates here, spot rates in particularly. And because as we all know, I've made a very important projection this year that spot rates are going to be above contract rates by the end of the year. So, yeah.
Bold call.
I mean,
and I say it's a bold call because what rate are we talking about? If you're talking about an all-in rate versus a rate X fuel, like you're comparing apples and oranges.
I'll let you know which one I pick at the end of the year.
I mean, that's going to be the one you have to pick because the spread is so wide between the line. I mean, you're talking right now, $1.57 is the NTIL, so that National Truckload Index, the line haul only.
But I don't know if that's really the right one we should be using when we're talking line haul. It's probably using the NTI 12.
Okay, fair. What is it? It's still declining, right? I mean,
we don't need to go into it. We don't need to go into it.
I mean, what?
Listen. The thing is, here's what you need to. All right, while Tony's getting distracted over here, all right, reading Twitter, what you need to be looking at is the blue line on the chart is tender rejections, okay? They've been going up lately. In fact, they're at nearly their high this year. Spot rates, the NTIs, that green line there along with it. Look at the chart. It tends to follow tender rejections. Now, it doesn't always follow immediately. Sometimes it does, sometimes it doesn't, but it does always follow. And right now, it's been a little bit flat, so really the market hasn't realized that there is the ability to push a little bit of pressure up on rates. In fact, we don't have it on the screen in front of us, but our NTI forecast, which is forecast truckload spot rates, is going up through Labor Day. So I think we're going to see this number go up, and if tender rejections continue to push higher, which they will because intuition, then we're going to see spot rates go even higher.
You're going to see a reaction to Labor Day. It happens all the time. I mean,
tender rejections are higher now than they were during 4th of July and Memorial Day. And we're not even at Labor Day yet.
Abnormal, right? I mean,
abnormal.
Yeah, it is. I think going back to your point about contract versus spot and the inflection there.
It's a great call.
To put it in perspective, the NTIL 12, so using $1.20 per gallon as the base for fuel, is at $1.75. The contract rate is at $2.32 per mile. So you're talking almost 50-cent difference.
What's the problem?
My question to you is, how do spot rates get above?
It's 57-cent difference.
Yeah.
Well, see, here's what's going to happen is as the market tightens, people raise their spot rates.
57 cents.
Maybe contract rates come down. Contract line haul comes down to $2.10, and spot rate line haul goes up to $2.14.
You are hopefully optimistic, aren't you?
Listen, I'm an optimist. Okay, I'm out here rooting for the people. Okay.
Yeah. I mean, it would be a good thing, right?
And
for participants.
Listen, the thing is, tender rejections are on the rise, and tender rejections don't lie.
They're at 4%.
Yeah, and they were
which is still deflationary for rates.
1,000% last week. So they're at 4%. It is deflationary, but also fuel is on the rise. It's going to push more people out of the market.
Hopefully, right? Yeah. I mean, you still have to see it, right? And I was having a conversation today, and you are seeing revocation capacity leave the market.
Yeah.
It's just not at the rate anybody thought it would be. Everybody thought it would be a lot faster than it was. Mm-hmm. And it just hasn't been that way. And does this increase in fuel cause that? And hint, in the Daily Watch tomorrow, there will be a discussion about fuel and rates and what it's done to carriers' operating ratio. And holding everything else equal, right? I mean, inflation is still rampant in some of these areas, right?
Yeah.
You're talking, if an owner-operator, just put it in perspective, if an owner-operator was running at a 95 OR back on July 23rd, the NTI was 223. So
95 OR, for those curious, is operating ratio. It means their margin.
Yeah, so basically a
5% margin.
Yeah. So effectively, for every dollar that they brought in, they were spending $95 cents to operate. Yes. So NTI 1 month ago was 223, right?
Yeah.
All in spot rate. The average price of diesel was $3.92 a gallon. If you we're going to say 7 miles per gallon in miles per gallon, the fuel efficiency. It's 7 miles per gallon. That's a 56-cent per mile cost for fuel. At 95 OR, your total cost is about $2.12, right? Fast forward to today, the NTI is $2.24, so you've seen a 1 cent increase in that all-in spot rate. Diesel prices on a cost per mile basis are up, what? They're at 63 cents, so you're talking a 7 cent increase. 7 cent increase, holding every other cost equal, is a 7 cent increase. So from 212 to 219, the carrier's operating ratio would have gone from 95 to 98 just from that increase in fuel. Yeah. You would have cut your margin would have been cut in half just from fuel.
I feel like you're helping my case.
I mean, the problem is what happens if fuel goes down?
Yeah, it could.
I know. Go look at the NTIL that accounts for fuel coming out. Those rates have continued to decline, right? That is my concern. I don't think fuel's going to go down. I think fuel in this instance is going to act, because if you were at a 98,
fuel's going to go down.
Just because the spread between the wholesale and retail price is still relatively narrow on where they've been in the last 6 months, right?
Okay.
It's typically been at about $1.30, and it's right around $1.10. So you have about a 10-cent increase possible, or 20-cent increase possible for retail prices if rack prices hold. We'll see if that happens. They're volatile. They move. They lead that retail price. The difference is, even if the rack price comes down, that retail price is a lot slower to come down. It goes up a lot faster, but it is a lot slower to come down than what the rack price is going to be. Carriers, in this instance, that are operating in the spot market, primarily buy retail diesel fuel, right? They're playing retail prices.
Yeah.
So again, that is the concern I think I have, is that, say you were operating in a 98 OR, right? I mean, take this a step further, 98 OR. What does that look like? If you were operating at 98 a month ago, what is it now?
Probably about 101, 100.5, somewhere in that range.
I mean, we can look at it right here. I'll change it real quick.
He's got
98. So at 98 then, it's similar. I mean, it doesn't change a whole lot. But still, it's one of those things. I'm good at, again, pay attention to the Daily Watch tomorrow if you're a Sonar subscriber, because there will be a discussion about this. Just because I think it could be a catalyst to push carriers out of the market, which is needed for the market to really recover.
Good. Well, we'll see what happens. Well, what I do want to focus on too as well is we've seen a big shift in a post-COVID market, right? Where I think the freight markets have changed, and freight markets change, I think, also as population patterns change, as people change where they live, where they don't live, where they order things from. We've seen nearshoring happen. We're continuing to see trade with Mexico and Canada increase. Now Mexico is our largest trading partner. Canada's number 2. China's down to number 3, right? And it seems like that trend's only going to continue, and the gap widen further. So that changes where freight comes from, where goods are imported, where they're not imported from. I want to go ahead and show this map. Now, let me explain this map for those that aren't aware. Tony, when you think of some of the best trucking markets historically, when you just think in your mind, what comes to mind?
It's LA, Ontario.
So SoCal.
So Southern California, Dallas, Chicago, Harrisburg, Elizabeth, New Jersey, and Atlanta.
All major metros. Not even just major metros, but like service areas, right, where they're going to service, greater populations, right? Ontario, California is a great place where they redistribute, goes through all over the country. Harrisburg, PA, basically services that massive population of the Northeast. I think I read close to 1/3 of the U.S. population lives within a 300-mile radius in New York Metro. So there's a lot there. So what this map looks at is the market share change over the last year. So this isn't necessarily like the current market share. If it was current market share, markets like Atlanta and Dallas and Phoenix and Ontario, LA, Chicago, Atlanta, Harrisburg would all be like really dark blue. They'd be the biggest markets.
Yep.
But this map looks at the change over the last year, meaning the markets in blue are the markets that are gaining in market share, meaning more freight is shipping out of those markets relative to other markets.
Yeah.
And the red markets are losing market share, meaning less goods are shipping out of those markets relative to to other markets. That's the key. It's relative, right? So this doesn't necessarily represent absolute volume. It represents volume as a pie, as a percentage, right? So if the entire U.S. market is a pie, basically the darker blue markets now have a bigger portion of the pie
than they did a year ago.
Than they did a year ago, and the red markets have less, and the white markets unchanged.
Yeah, and I think the way to think about this is, say, for a market to get bigger, something else has to get smaller.
On this map.
On this map, right?
On this map.
So think of an Atlanta, right? Volume's not down all that much on a year-over-year basis, but you look at this, that it's lost a lot of market share.
Right.
Relative.
Atlanta's that red market there, kind of in the bottom right.
Yeah, it's almost like the only red market in the Southeast, right?
Just about.
And then you look around it, I mean, you've seen growth in Greenville and Savannah, expanding outside of the Atlanta market.
Even look at that market there, like Jacksonville, Florida, right? Everybody thinks of Florida is like the worst place to be.
Go to the West Coast and look out there. Look at Ontario. It is losing share to Phoenix. And I think Phoenix, that's one of the...
LA is just barely blue. Phoenix is an interesting one. Why do you think Phoenix... And the other one I'm going to call out, Phoenix, and I think the other major winner, Elizabeth, New Jersey, which is the top half of New Jersey, way up there in the Northeast. Why do you think those two markets are seeing such growth relative to everybody else?
I think Phoenix is one, people are just not going to want to deal with regulations in California.
Yeah.
I know it's one of those things almost getting ahead of it by moving. And you have to remember, Southern California is almost landlocked, right? Because there's a mountain range that basically runs there. So you've got to move things further. To me, if this continues, right, you have to remember the regulations in California, right, with CARB. There's not going to be those internal combustion engines, those diesel engines are going to be basically banned coming up within the next few years. I think it's, 2030? Yeah. So, I mean, you're taking a segment of the population. If you think Los Angeles and Ontario are driving a lot of freight demand, but remember where a lot of carriers are based out of. I mean, you have a lot that are based in California, but you have a lot that go into California to get freight to come back to their home base, right? So if you're not allowed to go in with a diesel truck, you basically have to stop at the border, or you're going to have to switch to a net zero emission vehicle, which the infrastructure is not built out across the country, right?
Yeah, it could take a while.
It's not really built out in California either. So I think just getting away from the regulations, and I think you're dealing with people are looking for alternatives, right? And cheaper alternatives. And
Phoenix is also seeing a big population boom.
Yeah.
California's population has shrunk just a little bit.
Yeah, so I think that is a reason why you see Phoenix as a market that is primed for growth and sustained growth, and not just this one-off. I mean, you do see...
Still a backhaul market, but not nearly as extreme as it once was.
Yes.
The other one is everybody talks about the Northeast as a backhaul market. Elizabeth, New Jersey is continuing to grow, and I think a big part of that is East Coast ports have stolen a little bit of market share from those West Coast ports.
Yep, same
West
with
Coast ports aren't going anywhere. They're still going to be incredibly relevant.
Yeah.
But they're not like the dominant player anymore.
Yeah, especially as infrastructure gets built out. I mean, look at what Savannah's trying to do, and then you go Port of New York, New Jersey. You look at those two. They've gained a lot of share. They're taking it from somewhere.
Yeah, and if you're trying to funnel goods throughout the Northeast, that's a great place to do. That's a great place to have it. But anyways, folks, we're at the end of time here on With Stoner. Hopefully you enjoyed it. We've got a lot more content coming up. Stay tuned. Don't go anywhere. And remember, F3 in November. Take care.